Yes, I think the worst of the global financial crisis is definitely behind us, but I think the outlook for various economies is going to be quite different. If you take Australia, for example, we went into this with zero debt at the federal level, and so the government's been able to spend up quite extensively without really running into any serious debt problems. We had a very strong banking system to begin with, and so that's come through this global financial crisis, very well indeed, continuing to lend. We've also had very strong links to China, and that has meant that we've been able to piggyback the strong growth that's come out of China. If you contrast that with the US economy, they've gone in with already very high levels of debt. They've added to that debt, and that debt has to be unwound at some point, which is going to restrict their growth. They've also got a situation where their unemployment rate is at 10.2% and probably still rising. So by the time they start to unwind that debt and deal with the unemployment problem, I suspect they're going to face a very stop-start recovery phase where they're going to struggle to get any real sustainable growth going for the next year or two. Australia, in contrast, can probably return to fairly normal levels of growth, which is 3 to 3.5%, fairly quickly. I don't think inflation is going to be a big problem for Australia. We're starting from quite a low level, so we're already below the Reserve Bank's band of 2 to 3%. When you look at the sorts of things that are likely to keep inflation down, we've got a very strong dollar, which helps make imports cheaper. We've also got a situation where, while Australia is recovering quite nicely, the rest of the world remains quite soft, and that will keep inflation in check globally. If you look at various parts of the country, however, I suspect you will start to see some inflation bubbles in certain areas. Typically that's going to be in the resource-rich states, where as we re-enter a phase of resources boom, we're going to see prices begin to get stretched for things like wages are going to go up, things like restaurant prices and so on are going to go up, and housing, of course, will experience a bit of a bubble in those types of states. Unfortunately, I think the answer is yes, interest rates are likely to rise further from current levels. If you look at the sorts of cycles that we've been through in the past, I suppose the good news is they're unlikely to rise as much as we would have expected in previous cycles, but that's really because consumers are more indebted now, and so every 1% increase in interest rates really has a much bigger impact in terms of debt levels for households. So if interest rates return to what I think will probably be a normal level this cycle at about 4.5%, what you're really talking about is mortgage rates probably north of 7%. So these are the sorts of rates that people should be factoring in if they're repaying housing loan debt. On the flip side, for pensioners, of course, it means that they will get higher income as a result of these higher interest rates. And already some of the term deposit rates have moved above 6%, and I'd expect them to go at least another % higher. Well, since the market bottomed in March 2009 at around 31.50, we've seen it rally about 55-60% since that point. My view was the first 35 or 40% of that made a lot of sense. Stocks had been very oversold. People were starting to factor in Armageddon scenarios. They really didn't think there was ever going to be a recovery. The extra 15 to 20% rally we've seen since then, I think, concerns me a little, because we really need to see sustainable sales growth coming through to support that. And what we've seen is cost cutting being one of the key supports for profits in the equity market. That can't continue, obviously, and some sales growth, but a lot of it's been supported by what we've seen through the government stimulus packages. As that begins to unwind, we need to see self-sustaining sales growth. The good news, I think, is we probably are starting to see some of that emerge through the pipeline. And so 2010, probably second half, and into 2011, we will start to see sales pick up and companies become more sustainably profitable. So my guess is in 2010, the equity market, stock market here, can do high single-digit returns. It's an interesting question about where we should invest clients' money at the moment, because a lot of people, I think, are making the mistake of equating strong growth in Asia with strong financial returns out of that part of the world. And while that's probably true, it's certainly not the only source of strong returns that people should look at. Clearly, Australia is a good example where our resource companies are going to benefit from the strong growth in Asia and piggyback that ride. But there's other areas of growth and return too that investors should look for. So if we think about the world and its current situation today, there's a lot of weak companies out there. We can see a lot of M&A or merger and acquisition activity occurring, particularly, say, in banking and insurance sectors. Those provide a great opportunity for strong returns for investors as well. Also, the new technologies which are emerging as we move to a lower carbon economy, you're seeing wind, solar, even nuclear power as areas of good return for companies that supply those industries. So I think while Asia is an important part of an investor's portfolio and certainly shouldn't be discounted, it's only one source of growth despite the differences that are likely to occur in terms of the economic growth that comes out of different regions. Well, currencies are always probably the most difficult thing to forecast in financial markets. But if we think about the Australian dollar and it's hit the 90s, will it get to equal footing with the US dollar going forward? My guess is it probably won't. The Australian dollar has a lot of things going for it at the moment. Our interest rates are relatively high compared to most other economies, but particularly the US. We've clearly got the resources boom going for us. And we've got a situation where there's a lot of doubt around the US dollar and concerns about the economy. But with all those things going for us, we've still got a situation where virtually every major good and service that's traded in the global economy is priced in US dollars. And so having that reserve currency status really lends itself to a natural demand for the US dollar. If I think back to the last boom that we went through in 2007, we saw a lot of the same sort of positive factors working in favour of the Australian dollar, and we didn't get to that equal footing level. So I think we'll probably struggle to do so again this time.